One of the interesting developments that we've been watching across Asia this year is the risk of whether inflation is likely to pick up at lower levels of growth than historically has been the case. And the recent data points that we've seen across the ASEAN reinforce our conviction that that is actually what is happening. For the month of May, figures released this week have shown that inflation is picking up more quickly than expected in the Philippines, Indonesia, Malaysia, and Thailand. And this has been rather unusual given that the levels of growth we're seeing in the G3 remain a little bit softer than expected, and China is also decelerating at this stage. And we think there's three principal reasons for why inflation is picking up and why it's likely that Asian central banks will need to raise rates in response to this. The first is the supply side of the Asian economy is changing and has changed considerably since the global financial crisis. The second is that input costs are rising, particularly electricity prices, very, very quickly across the Asian economy. And the third is that we're seeing changing drivers of demand in an environment where the ability of the Asian economies to grow at the levels they did pre-crisis is probably a little bit lower. So let's have a look at those three dynamics individually and then see what that means for policy across Asia. The first is that the supply side of the Asian economy is changing very, very quickly. Production used to be almost entirely located in China, but with rising labour costs in China and political tensions between Japan and China, many Japanese companies are now shifting production platforms to the Philippines, Indonesia, Thailand, and Malaysia. And what this is doing is adding industrial demand for electricity to the electricity grid for the first time. So we're seeing electricity prices rise very, very quickly. For instance, in Indonesia, electricity prices have risen 30% this past year and are forecast to rise another 28% over the coming year. So for some types of manufacturing, electricity prices represent up to 30% of input costs. So input costs are rising very quickly, despite the fact final demand remains quite low at this stage. The second factor is we believe the potential growth rate, or the natural growth rate at which the Asian economies can grow without triggering inflation, is actually lower than it was pre-crisis. And one of the key reasons for this is that there's been a low level of investment in industrial and production capacity post-crisis. The lack of corporate visibility, the fact that it's been difficult to gain access to long-term finance means there hasn't been the build-out in capacity and infrastructure that we saw pre-crisis. So the actual natural level of growth for many of the ASEAN economies is probably a little bit lower than previously thought. The third reason why we think inflation is picking up is the lagged effects of currency depreciation. The US dollar is starting to strengthen and will continue to strengthen as the Fed commences interest rate normalization. Asian interest rates have been weakening and Asian currencies weakening as capital has flown out of Asia over the so-called taper tantrums of 2013. And this means that input costs and imported costs for Asian factories are also starting to rise. So when we put these factors together, it's not surprising that even at these modest levels of growth we're seeing in Asia at this stage, inflation is starting to pick up and pick up quite quickly. Now, in the second half of the year, this is going to have policy implications. Asian central banks are already starting to sound a little bit more hawkish. We're seeing the Central Bank of the Philippines start to tighten liquidity within the economy, and we think around June or July, it's actually going to move to start raising interest rates. Malaysia is a similar story. Input costs are rising, inflation is picking up firmly. We think Malaysia will start raising interest rates around July or August. And then for Indonesia, which has been tightening policy already, which has a presidential election in July, that's likely to delay monetary policy tightening. But we think around the third quarter or fourth quarter, interest rate hikes will become necessary in Indonesia. So in conclusion, what we're seeing across the ASEAN economies in particular is inflation is picking up at lower levels of growth than analysts previously expected. And at ANZ, we think the inevitable conclusion of this is that ASEAN central banks are going to need to start tightening policy sooner rather than later. And this is a dynamic that we'll be continuing to monitor.